mortgage rates. So while prices have been coming down, right? I mean, we're off the highs. Would you say prices have peaked? Also, we've had some fluctuation in mortgage rates. So when they go down, people jump in, right? And when they go up, tell me about the relationship that you're expecting. Should people be buying even if the prices seem to be more reasonable, if rates go higher? I mean, what's the relationship there, and what should people be doing?
Yeah, so like I said, home prices have been declining since last spring's peak. And at this point, we're down about 3% nationally from that peak. And what's helped home prices is decline in mortgage rates. So ever since, as I mentioned, mortgage rates came down, some buyers jumped in, and that lack of inventory is keeping a floor under home prices. And so in our February release of Home Price Index, we already saw a rebound in monthly change in prices. So after 7 months of monthly declines, we saw home prices increase at 0.8% from January to February. And that's double the increase that we generally see between these 2 months. So it's suggesting that home prices have bottomed out and we are now on the uptick again.
So at this point now, in the long term, is it better for someone to buy a home and they can readjust the mortgage rates later? Or, I mean, what if a recession comes?
Well, yeah, it's individual decision. I always say that because, people are in different stages of their lives and their incomes, the income is the most important thing here. So if they have confidence in their job, in their opportunity to find another job, if they, potentially lose a job, that's really what should drive their decision. I do here, we do anticipate some type of recession coming on a lot of part of this year. But I think by all accounts, the consensus is on a mild side of the recession. So, either growth recession or mild recession. So I don't foresee large increases in unemployment, and we've already seen a lot of folks laid off and not consumer increase in unemployment claims, so which suggests that people that have been losing jobs, in fact, ended up finding jobs rather quickly. This is a one indicator to keep an eye out for, because it has increased the last week's data. So it is something to keep an eye on. But I certainly do believe that if folks are in a good employment situation, that they should, that should be the primary driver of the home buying decision.
Okay. And then just tell me about the regional story, or maybe the ages. Are you seeing themes, whether it's regionally, some areas are hot or not, or is it, and who's buying or selling as far as age groups maybe?
Absolutely. There is quite a bit of regional variation. Housing markets on the West Coast and Mountain West have not done as well. There's been a large double-digit decline in home price since the peak. I mentioned nationally we're down 4%, but in some of these West Coast markets, we're down as much as 14 to 16%, particularly Bay Area, Seattle, some Idaho markets. So markets that did really, really well at the onset of the pandemic, and that saw a lot of immigration from coastal West Coast markets. They did really well at the onset of the pandemic, and now there's that home price resetting of home prices because the immigration slowed and local residents can no longer afford those homes or those prices. So we are seeing some reset there. In terms of who is buying, it's really interesting because existing homeowners, or generally older homeowners, have locked in these really, really favorable mortgage rates, and they're not necessarily moving right now. But the first-time home buyers that have been competing over the last couple of years with everybody else, and now that competition has waned, they're being more active in the market. So we've seen increase in first-time home buying activity in terms of mortgage applications. But then on the other hand, for elderly, such as older baby boomers who have accumulated a lot of home equity in their homes, they may be now cashing out of these more expensive markets and moving to more affordable markets. So moving basically into their retirement homes. So we do see the two spectrums of the market move, but the folks that are in the middle are the ones that are not necessarily making any changes at the moment.
And then we always see when people have certain parameters, whether it's a rental property, maybe a multifamily or a mother-daughter, or something that they can, instead of a single-family home, have some sort of money-making opportunity there. Are there some parameters that you find people ask for often? I mean, I'd love to say it's just a swimming pool, but it's got to be, school systems, things like that, right?
Well, homes in good school districts always do well, and it's still also very much a regional story. So areas that have seen large job growth,
order filled.
Tax for some folks, it's tax advantages that they're paying attention to. In terms of the types of homes, we definitely have seen more multi-generational housing being in demand. Also, for markets on the West Coast, for example, where there is space to build an ADU or granny unit, as you mentioned, those homes are in demand as well, given just some of the changes that we saw in the laws in California in particular. But wherever we can add more housing on a potential lot, that's good. That bodes well for that home.
Yeah, understood. It's great to see you, Selva Hepp. Thank you so much. And I know you had all the very latest data from the report. Appreciate it. Chief Economist at CoreLogic. Thank you, Selva. Still ahead, we bring in our panel to discuss the March employment report, the situation. We have a very tight labor market still. I know it's improving in the Fed's eyes, but what do we need to know? Our panel's ready.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Welcome back to the watch list. To break down the March employment report, that came out early on Friday morning. The stock market was closed. It's our opportunity now to sort of delve into those numbers, what the Fed might be thinking too. We bring in our expert panel. Frank Steamers is with us, senior economist at the Conference Board, and Richard Walquist, president and chief executive officer at American Staffing Association. Thank you both for being with us. Frank, what was your takeaway from the latest report that we got on Friday morning?
I think what really stood out to me is that this jobs report was actually still very strong. Yes, it was not as strong as the 500,000 jobs in January, about 300,000 jobs in February. But if we compare it to pre-pandemic job gains, this was still stronger than the 2019, 2018 averages. So I think we're still in a very tight labor market. Job growth is still strong. We're still looking to see some weakness. There may be some pockets of the economy where there is appearing some weaknesses, but overall still very strong jobs report.
Yeah, and that's the whole thing. And employers are still saying they're not able to necessarily find the staffing or keep the staff. I mean, labor is still a very big issue, Richard, right?
Absolutely.
Stop filled.
I agree with Frank. The jobs report was very affirming of what our members are telling us, and that is that there is still a labor shortage. And inside of that labor shortage, Nicole, people are still resigning and looking for new jobs. But there are a couple of really bright spots, and those include the fact that the unemployment rate for women is at an all-time historic low, and the unemployment rate for Black African Americans also at a historic low level. So some really positive news in there for people who are working and people who are seeking work.
Yeah, I think you make a great point. And I think there was some celebration, believe it or not, within the labor force participation rate that men were coming back in because, to your point, Richard, it was a lot of women, diverse hires. And so, Frank, did you see that? I heard that on the radio on Friday that there was actually some showing of more men back in the workforce in the whatever range it is, 18 to, I don't know if it's 24 or 54 or whatever, but I did make note of it.
Yeah, I think that was, of course, the big conundrum. We saw labor force participation really drop after the outbreak of the pandemic, not really picking up, especially actually men staying home, not rejoining the labor market. And this was, of course, a big puzzle because wage growth was very strong, job openings very high, so you would have expected more people to join the labor force. It may have taken some time, but we indeed now see that women and men are rejoining the labor force. Of course, the big question is now for how long will more and more people continue to join the labor force when the outlook is maybe not looking as rosy?
Yeah. And here's the thing. I mean, to your point, Richard, when we were saying about the labor and the market and people trying to find, we still see hospitality and leisure, a lot of turnover and churn and moving around. You do have layoffs, you do have quits, and we have job openings, which pulled back some, which show that the Fed's rate hikes are working. What's your thesis now as you take a look at this, Richard, and what's going on in all these moving parts?
There are a lot of moving parts, and again, there is some good news and some mediocre news. The good but mediocre news is around the labor force participation rate. We're still at levels we haven't seen since the 1970s. Yes, it picked up a little bit, but I tell you what, Nicole, I mean, we need to continue to put all businesses and the government on getting workers off of the sidelines. At the same time, it's related to this, working on immigration policy. But yes, we are seeing that huge demand continues to exist, and it's actually constraining GDP growth. Regarding interest rates, thanks for asking. You know, we've been beating the drum pretty hard for the last year and a half. We understand this is a big lever that Jay Powell has to try to raise interest rates to break the back of inflation. But again, the numbers in just the last couple of weeks, I mean, if we saw a 1% increase from 3.5 to 4.4, 4.5% at the end of 2023 or 2024 in terms of the unemployment rate, we're talking about 1 to 1.6 million people out of jobs. That means they're not working. That means they can't buy things. That means consumption's going down, and that's a key element of GDP in America. So it's all tied together. And the fact that we had this little banking crisis perhaps is causing the Fed to take another look at interest rates hike. Take their foot off the gas, I think now's a good time to do that.
Yeah, and Frank, you noted that some of the tech, transportation, construction, they are maybe more at a greater risk at this point. The final takeaways here, Frank.
So in the tech sector, we already have seen all these layoff announcements. When we look at transportation and warehousing, grew very fast after the outbreak of the pandemic, maybe a little bit too fast because now consumption has shifted back towards services. So over the last couple of months, there we have seen employment kind of moving sideways. So I think this is a sector at risk. In addition to that, construction always hard hit during other recessions. This time, maybe the same is going to happen because the housing market is, of course, also weakening.
Yeah. I think about the labor force participation rate, Richard. It was something I followed very closely in my entire career, and I start to wonder if we can ever get back to those levels with the baby boomers retiring and technology stepping in. I think there's some celebration that we're back to sort of pre-pandemic levels. I don't know, Richard. I mean, you can leave me on a final thought, but also, what would you tell kids in college to study?
Those are great questions. And by the way, Conference Board has got a job risk indicator that they just launched. So I'd say take a look at that. The industries that are relatively bulletproof, and it includes the trades. And so you ask about the kids that are in college. Not everybody needs to go to college. It's a great way to prove to the world that you've got stick-to-itiveness. But we understand that employers these days are not looking at college degrees as much as they're looking at skill sets. And so I would say take a look at the ASA website, take a look at the Conference Board, take a look at the jobs that are relatively recession-proof, and those are in the skilled trades. I mean, if you're a truck driver, if you're a Mac welder, if you're a forklift operator, in skilled professions, absolutely. We've got a shortage of doctors and nurses and clinicians and practitioners that isn't going away, and the same sort of thing in the IT sector. And I'll tell you this, Nicole, for all of those vaunted layoffs that we see for the big tech companies, our members are finding a home for all of those people. It may not be at a splashy company with a great big name, and there may be a little bit of an adjustment in the compensation package. They can't compete with an Apple or a Meta, but those individuals are very much in demand. And I would say IT careers, program careers, cybersecurity careers, absolutely.
Okay. Richard Walquist, American Staffing Association. Frank Steemers, the Conference Board. Thank you both very much. Good to see you. That's going to do it for us here on the watch list. I'm Nicole Petalides. Thanks for being with me. I'll see you tomorrow at 11 a.m., but keep it right here. Market on Close is next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Order filled. Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Good afternoon and welcome to Market on Close. I'm Oliver Rennick. We've got stocks trying to push positive across the board after a bit of a rough start here to this week as the NASDAQ was dragging its feet, but it's caught up. Russell's having a great day. Small caps up 1% right now. NASDAQ and the S&P just slightly red at this point, and it's been a pretty good comeback. So we are within 2 bips for the S&P 500 and a tiny bit more for the NASDAQ. Steady grind up off the lows all afternoon through lunch, basically since the bell rang, as we got an early dip that didn't last very long. By 9 a.m. Chicago time, buyers have come in, dip buyers specifically, as there was that dip earlier. But market's looking very resilient, and notably with Bitcoin up 5.5% to 29.5. We're now the highest we've been in several weeks. This is one of my key tells that I've been watching very closely here. There are a few big charts coming into this week. Bitcoin is one of them. It's been plateauing just below 29. This is now potentially a technical breakout. Still want to see if it can get through 30K. That's a very important level. For Bitcoin, those big whole numbers that act as pivot points in the past are oftentimes doing the same in the present when we get back to those levels. 30K on the way up as we went from 2020 to 2021. That's the calendar year. 30K was the midpoint that sent Bitcoin way up into the stratosphere of 60 to 70K. And then on the way back down, we attempted to break 30 multiple times, failed, bounced until eventually BTC got stuck at 30 and then FTX blew up and so did the coins. We went down and now we've been working our way back. So here we are basically. If we can get through this level, it's probably a clear sign that risk on is the trend across assets and that the message about potentially a major pivot from the Fed could be real. Have to be very careful with this stuff though, as Bitcoin remains very high beta, high risk, and speculative. If you're hearing people attribute this to the bank stuff, it is garbage. It has nothing to do with it. It's very clear every time this happens. People will tell stories, and the stories are going to get loud. But the only story that really makes any sense that matters is that this remains a very high beta asset that moves with the NASDAQ. Same chart for the NASDAQ over the 6-month period. The correlation between Bitcoin and the NASDAQ has been 0.9 over the last 30 days. 0.9. That is basically the same line. Now, that's very useful for us as traders. So even though there is really no bearing to the fundamental tie-in to the financial situation we went through when it comes to the Bitcoin rally, we can appreciate what it is as an indicator of risk-taking sentiment, and we should, because oftentimes it does usher in big regime changes in the market. Right now, the market has been trying to create a major regime shift for months. The narrative around a Fed pivot got some legs last week as we saw jobs numbers deteriorate. We'll talk about that a lot this week as we have inflation on Wednesday. Now, we're in an interesting spot because at the same time the dollar is actually higher. This is kind of bizarre. You got gold down, which does kind of give a more risk-off tone, but the dollar bouncing right at an interesting moment when you'd think it would be breaking down means that we still really have a decision up in the air here. Because if we're going to get a big macro regime shift to a Fed pivot, lower rates, higher Bitcoin, higher tech, and NASDAQ leadership, the other parts of this market don't really line up with that today. You've got the regional banks doing solid. You've got the cyclical trade in the market doing well, doing better than the NASDAQ. The Russell is leading. You've got the dollar higher. And bonds in price are down a little bit, yields are up marginally, but the big move in bonds already happened. So I think that is kind of a ship that has sailed here at the moment. It's going to take a lot to turn yields back higher here. We're going to have to either I don't know what we're going to need for yields to get higher, to be honest, because it kind of seems like at this point we either have inflation as a major problem and economic weakness together, which is basically stagflation, or you've got real deterioration in a Fed pivot coming, but for recessionary reasons. It's just hard to see why bonds would start selling off real hard. The dollar, however, could catch a bid if the Fed's going to keep hiking despite the economy slowing down. So it's really interesting to see the dollar firming up at the lows. Don't really know what to make of it just yet. With 10-year yields over the past week making new lows, you'd expect the dollar to follow. I've talked about that a lot. So that's another one of the really key charts here that we have to keep in mind. Bitcoin breaking out kind of goes against the dollar firming up, not because the dollar and the Bitcoin compete whatsoever, but because of what they represent. And generally when the dollar is firmed up, it's represented a risk off tone. It could just be some chop. Don't want to get too hung up on it, but definitely want to watch it carefully. Also too, because gold is coming off a little bit, and gold has been a really great performer. Gold held its value throughout the last year. Gold's at 3-year highs right now. Gold seemingly has been kind of a catch-all trade, whether investors are worried about inflation or they're worried about recession. Gold's been catching a bid and has been solid. Bitcoin, on the other hand, has been clearly tied to tech strength, NASDAQ strength, a Fed pivot narrative, whereas the dollar basically is opposed to a lot of that, where if the Fed's going to keep staying on the path and fighting inflation, dollars are going to stay bid. Maybe we get answers to this conundrum by the end of this week, as we are going to hear from the FOMC in the minutes. We're going to get the inflation print on Wednesday. Banks are later on in the week, which is going to be interesting. You probably want to watch crude oil as well. Exxon's doing all right despite the Wall Street Journal story about them maybe taking over Pioneer. A lot of times you get a big buyer like that to see their stock price drop on a report such as this, but they didn't. And crude oil is in an interesting spot too, back at multi-month highs here following its big bounce after the OPEC cuts. So you got a lot of moving parts. The highlight certainly here is the Bitcoin move, which oftentimes can usher in a big wave of risk on, but there are still some things kind of pushing back on that maybe we'll get some resolution for through CPI, but that's still a couple days away. It's a fun start to the week, though. We got Kevin Hanks, Renita Young here with me to make sense of it. Some of this kind of conundrum of the market right now is actually even within the tech sector alone, Renita, because you've got some big winners, and then you've got some big losers. You got Apple that's been dragging all day. The NASDAQ would be higher right now if it weren't for Apple. And Tesla too. But then on the flip side, you got Micron doing great. Let's start with Apple because the NASDAQ's still red here. It's been grinding back, but still down 2%.
Still down 2%, and it's down for a similar reason that Micron is actually higher
Yes,
today.
this is weird.
Right, it is weird. So Apple is down because of reports that it had dropped a 40% drop in its actual deliveries and its shipments for PCs in the first quarter. Now that showed this struggle with unsold inventory just continues. Right? The slowdown in consumer spending is starting people to, or making people be a little bit more careful with their non-discretionary spending. And so the International Data Corporation said that on a whole, though, all PC shipments were down 29% to about 56.9 million, and that's below the levels of early 2019. Now, no major company was spared from this. Both Lenovo and Dell dropped more than 30%. HP dropped by 24%. But Bloomberg Intelligence says that although these PC market declines have been happening for multiple quarters, a rebound is still possible in the second half of the year. I can't believe they're actually saying that. Maybe they're true, but the company is saying, or the analyst over at Bloomberg Intelligence is saying this because there might actually be a silver lining. This cooler demand may help the companies get things together as far as manufacturing. A lot of them are pulling out of China, so it may enable them to do that, get more domestic production. And they're also saying that maybe in the second half of the year, people may pick up on demand a little bit. But it's hard to believe right now.
It's very interesting. It's kind of like we're threading a needle. It's kind of a double-edged sword, these reports. And the Micron story is very much like this because Micron's up because one of their main competitors in the memory business, Samsung, is cutting down its inventory and production, more specifically, so they can move that inventory out. So you've got this admission of a company whose demand is not meeting the supply it has, and the market's rallying all these other businesses because it's maybe signaling that the problem's getting less bad.
Less bad, that's the theme. You know, we've been talking about this all year, how less bad is actually the theme, and how, you know, where are the demand kinks in the chain, so to speak, right? But you're right, chip stocks are actually higher today because of that news from Samsung. And it was part of this first quarter pre-earnings announcement that Samsung gave when it talked about how it'll have to make some meaningful cuts. And it's citing, of course, the slower demand. It's been exacerbated by inflation as well. And the company noted that it's driven a 96% annualized decline in its expected operating profit. That's pretty huge. And so we'll find out just how traders continue to follow this news throughout the week. But there was an analyst update on Micron in the wake of these preliminary results from Samsung. Citibank is reiterating a buy rating on Micron, saying that this company is now kind of better positioned to be able to win during the second half because of its DRAM memory market. It has a substantial part of the DRAM memory market, and this news may be better for the company as well.
What do you think about this, Kevin? Buying up stocks because their competitors are acknowledging diminished demand, and why does it work for Micron but not Apple, right? I mean, it's kind of strange. It's like this a very similar macro story for both these companies. One's up 7%, the other's down 2%. Ultimately, Apple matters a little bit more, but does this make any sense to you?
It does absolutely. You got to think of it from an investing or trading perspective, Oliver. And with these tech names, the semiconductors, you see that sector is up, even though Microsoft, Oracle, Apple, Salesforce, Adobe, they're all down. What you're looking for in these beat up names is any sign from the street, Oliver, that the worst is over. If you give that the all clear, then all these stocks are tradable again. They're not just going straight down. When you start to say that things are bottoming, which was a lot of the news in Micron a week or so ago, more of that today, that's all traders and investors need to start nibbling on some of these great companies that it looks like the cycle is getting to a bottom and starting to turn up again, Oliver. By the time the good numbers show up, these stocks will be way higher than they are now. So I think just the fact that the news is not as bad or starting to turn means it's a green light on a lot of these names.
Okay. The trade overall here ahead of inflation this week, the move in the market throughout the day higher, the Bitcoin attempt to break out here, this kind of wave of risk on, Kev, what do you think we need to see in the numbers to justify this over the next couple days?
Well, to justify where rates have gone and where the U.S. dollar has gone, they're telling you what some of the consensus is, that core CPI over the year-over-year core number is going to tick up 1/10, and that will reignite some upside move in yields and then the U.S. dollar. If that reaction to the stronger CPI numbers, it looks like the headline, that's expected to come down from 6 to 5.2, but the core year-over-year is going to go from 5.5 to 5.6. That will not be a great confidence maker for bond traders. And I think that's why you're seeing yields firm up here, because some of the consensus is for core. And then we'll get to PPI, then we'll get to retail sales. But Oliver, you know the CPI is such an important inflation data, the number one in terms of looking at inflation. If that core comes in up for year over year, I think bonds will firm up here and more rhetoric from the Fed.
Okay. What if all this cooling inflation is happening because our economy is slowing down? I mean, last week we saw for the ISM, prices paid dropped, but new orders plunged too.
Yeah, listen, the flow of economic data has been weak over the last week or 2 weeks. It's been a pretty steady flow of poor data, except the payroll data came in, I thought, surprisingly positive, right? It was good, solid jobs, lower unemployment, lower wage inflation. So I think that was a good number, but you're right. The overall data, if you take it in mass, has been pretty weak. Retail sales are supposed to be down 0.4 on Friday. So the rest of the economy seems to be weakened. But Oliver, how many times have we said it? Leisure and hospitality, that's keeping the overall jobs data, the employment picture, a little solid. I think this week's jobless claims is another hugely important number to see if that's just a one-off or do we have a new trend starting for higher levels. But I think as long as jobs, the job markets keep staying high, but we're getting mixed numbers. The jobless claims are good, employment good. We need to see some more weakening across the board like we've seen in the past. I think that jobs data surprised the market slightly.
All right. Appreciate it, guys. Thanks for the analysis. Yep. Kevin Hanks, Renita Young. Let's bring in Axel Merck joining us from the Namesake Investment Office, President and Chief Investment Officer at Merck Investments. Axel, welcome to the show here. So should investors be betting on a big change in course from the central bank, cooling inflation, or is that partying on the Titanic?
You are implying that the Federal Reserve has a course. You're implying the Federal Reserve has a strategy. I would allege that higher for longer is a tactic, not a strategy. And what I mean with that is the only thing that we know pretty much for sure is that the Federal Reserve will tighten into a recession, because higher for longer means that you're not really looking at anything other than contemporary data. And as we just heard, right, a lot of these data are with a lag. The jobs report, the survey for the jobs report was done in the middle of March. And so these things act with a lag. Since then, we've had a banking crisis. Smaller banks that have their balance sheets under a microscope will not be induced to lend at this environment. And then we know that things like commercial paper, that market, the commercial real estate, that market, there's a huge hole there when they need to refinance. And the Federal Reserve will be late in reacting to that. So will we have a change? No, I think Mr. Powell is rather set on its course, right? They'll raise rates and then they'll pause at some point. But none of that guarantees that inflation is beaten, because it's higher for longer is not tied to anything other than pretty much the opinion of a big committee that's a debating club.
All right. Conviction. I like it, Axel. So if then the Fed is kind of along for the ride and kind of subject to some of these whims without a plan, should we bet then that they will cave to the markets? If bonds keep pricing in these cuts? Is that where we're going?
In due course, but they will not directly follow the bond market. If my scenario is right, then we will have a more...
If they're going to go against bonds, kind of sounds like they do have a path.
Well, what we'll get is a more severe recession than the Fed would want, that anybody really needs or wants. And so what will happen is some really bad stuff could break. I mean, remember, the whole point of hiking rates is to break things. They want to break the little stuff. They don't want to break the big stuff, because monetary policy acts with a long and variable lag. So they will, I just hinted at the commercial real estate market, they'll break some bigger stuff. And then, yes, they'll scramble and we'll get much more than the rate cut. That we get it as quickly as priced into the markets right now, I'm not so sure. And the reason I'm not so sure is because nobody knows when the quote-unquote unknown hits you, right? The Silicon Valley Bank crisis, nobody knew the timing of that. People knew that there was an issue somewhere, but when that stuff blows up, only the market can tell you, and they'll tell you only when it's too late to prepare for it.
So how do we prepare then, Axel, at this point? Because right now there is quite a bit of division, as you know here. If you think there's pivots coming and a big change, there's a whole different set of stocks that have been working on that assumption. And on the other side are some diametrically opposed trends. It seems like the market's still very bifurcated on this point. So is there a way to kind of hedge which outcome there is, or do you have to pick a side?
Well, if you look at the dollar, it peaked in the fall of last year. That's kind of when the second derivative changed in the Fed policy, when from the very aggressive rate hikes, we moved to less aggressive rate hikes. And that trajectory, so to speak, to ever more dovish is going to continue. Other than that, the two scenarios you illustrate, one is a shallow and one is a severe recession. In a shallow recession, the market looks ahead, stocks can do well. In a more severe recession, stocks don't do well until pretty like 2/3 into the recession. And the thing that does well in a more severe recession is precious metals, gold miners. And if you look at the price of gold, that's been doing quite well. And so that portion of the market appears to agree that we'll get a more severe recession. As far as I'm concerned, I look at the market in terms of risks. And I think the risk of a more severe recession is significantly elevated with what the Fed is up to.
Okay. So where does that take you right now, Axel? Should we start to generally bet on things that are traditionally resilient during recession? Because right now this market is telling us that the new recession play is tech. It's growth stocks. It's companies that don't make money. As soon as our recession odds go up, that's what people pile into.
Well, all these are signs to me that we're not at the bottom, because there's still a lot of money going after these speculative bets. I mean, we might have an institutional bias. We launched the stagflation ETF a year ago. We manage over $1 billion in gold and gold mining. So obviously I might be biased. But if you, in my personal account, the cash I have allocated to equities, well, I haven't deployed any for months, because I think I'll have better opportunities to deploy that at a later point in time. In the meantime, I don't mind having cash on that front. On the institutional side, I have a mandate to invest in a certain way, of course.
Tell us how you're operating within that real fast, what you can, Axel, as we're close to being on time here, but we're curious to get some specifics from you. As much as you can.
Well, I mean, well, sure. I mean, on the stagflation side, we launched an ETF a year ago precisely because we figured there is no real plan. Stagflation, we call it a supply shock followed by policy mistakes. The politically attractive thing to do is the economically wrong thing to do. And similarly on the precious metal side, it's a diversifier. Last year, diversification didn't work pretty much no matter what you touched. And we think in this year, diversification will work in many ways. We happen to think on the precious metal side, it's one of the more attractive places.
All right. Appreciate that. Great convo, Axel. Good stuff.
My pleasure.
President and Chief Investment Officer at Merck Investments. Let's talk some stock picks and maybe get a bit of a different take here. As last time Ed Butowski was on the show, told us that the economy was slowing down, but that a deep recession was not in the cards. Let's get an update on his viewpoint when we return.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads, like counters and diagonals, are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Let's bring in Ed Butowski, joining us from Chapwood Investments, managing partner. Ed, good to see you again. Last time we were talking, we were discussing some of the same themes we are here today, of course, the odds of the economy slowing down. And you did tell us, we've gotten some data last week, namely some employment numbers kind of trailed off a bit. Does that heighten the concern at all for you?
No, it doesn't. I mean, you got to remember that the economy is it's almost like a big cruise ship, and it takes a lot to turn that cruise ship. And I don't believe that, 1 month of data that, was a little weaker than people expected is going to change the trajectory of the economy. I think the economy is going to be weak, but I do not believe we're going to have 2 consecutive quarters of negative GDP growth, but we're going to have very weak numbers. That's for certain.
Okay. Economy is a cruise ship, though. I don't know, post-COVID, Ed, you might have to pick a different slow-moving machine because those charts are a little bit ugly still. What do you think is the best way to play this situation that we're in right now? I know you got some stocks on your mind.
Well, there's 3 different companies that I wanted to point out. One of them is CarMax, and CarMax, used car sales have come down, or prices have come down 18% from their high. And I do believe that CarMax is the most attractive in the used car space. But the target price is only 1% higher than where it's at now. So, it's kind of a risky play, but there is some attractiveness to it if you think that used car prices are going to come down even more, which could happen. And also financing for these used cars are starting to come down. Well, not starting to come down, but they're starting to kind of go sideways. So when that starts to happen, there's a lot of pent-up demand for pre-owned cars, more so than new cars. Even though new car sales are dropping quite a bit, pre-owned car sales, and CarMax is going to be the winner if that does play out.
Okay, very interesting. CarMax and the competition have gotten into some pretty murky waters the past year. Do you think a company like Carvana, if it goes belly up, it would be a good thing for CarMax?
Yeah, I do. And I do believe Carvana is going to go belly up. They just don't have the financing. They don't have, they just don't have the financial wherewithal to withstand things. And those things that they built.
Vending machines.
Yeah, the vending machines are amazing, but we were playing around with the idea of turning them into pickleball courts the other day when they finally go bankrupt. And but I don't think any Carvana I just doesn't really have a chance. I just don't believe so.
Okay, CarMax has kind of gotten dragged though, so I guess the idea here is that maybe there's been kind of a thematic sell-off that might eventually see the quality companies emerge.
Yeah, I think you're going to see the quality. I think that's a great way of putting it. And CarMax is absolutely the winner in that sector. And, at some point, everything, the pendulum swings all different directions. And the pendulum swung so far down because you had, higher interest rates and you had really, really high pre-owned car prices. Everything negative was working against CarMax, and they're still sitting there doing pretty well. So, if you are a gambler, you might take a position in CarMax.
All right. Speaking of gambling, let's talk TSM, the chip maker that you like, Ed. I mean, it seems like all the evidence that I can see from a technological perspective is that they're a leader and they've broken quite a bit of ground technologically. But of all the chips and all the places, why pick the one that's in like the hottest contested geopolitical region outside Ukraine?
Yeah, well, maybe because I'm a gambler, who knows? But if you take away the China tension, and if you don't believe that China is going to invade Taiwan, and that's why they've been underperforming versus the SOX, the SOXX index, you will find that they are the best position, and you always want to get the best leader in their space. And they're 22% off their target price, and I would write calls against it when I entered it because there is some volatility in it, and I would lower my entry price. I would buy some, rather in the money calls or close to in the money calls if I entered this position. But they're just the leader, and you always want to buy the best. And if you can ignore the China tension, which is very difficult to do right now, but according to some military people, there's not going to be an invasion of China to Taiwan until 2025. So you have a year and a half at least. Let's put it that way.
All right. Speaking of industry leaders, last one here real fast, Tesla. What do you think about these price cuts? Does kind of seem there's some evidence here that maybe demand is slowing. I know that Elon's tried to spin it the other way. But looks like without these price cuts, it kind of seems like the implications with sales would be much lower.
Yeah, there's no question about it that they're lowering prices to stimulate the number of vehicles being sold. There was about 3 years ago, there was no competition. Ford, General Motors, Toyota wasn't in that market. Mercedes wasn't in that market, but now they are. So, and they have great distribution centers, Ford, General Motors, and Mercedes and Toyota. So, Tesla is definitely going to see that competition, even though according to some of my clients, they are obsessed with Tesla and never think Tesla can do anything wrong. And this mega pack that they just built in Shanghai is supposed to be a game changer when it comes to storage. So they're still a leader and they're still doing fantastic things, but the competition is there, and that's why they're lowering their prices. And the idea is that if they lower their prices, that'll stimulate the number of sales. So hopefully it'll come out being a break even for them.
All right. Appreciate the thoughts, Ed. Nice bang, bang, bang here. 3 stocks. Appreciate the details. Ed Batowski, managing partner at Chapwood Investments. All right, CarMax, Taiwan Semi in Tesla on his buy list. We've got at least a couple bulls in the options corner today. Tom's going to walk us through a few trades and all pretty much different parts of technology. A little bit of a bear fade, though, in Apple. I'll be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience that pushes you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Oh, yeah, I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position?
You two are all set.
Choose the app that fits your investing style.
I'm Nicole Petalides, live on the floor of the New York Stock Exchange, empowering investors every single market day. Tune in to the TD Ameritrade Network.
Let's talk some options here, and they're all pretty bullish. At least 2 out of 3 of them, yeah. Tom White. We'll start with Zoom, because if it's risk on, then Zoom buyers are definitely feeling emboldened here.
A little bit.
Okay, and that's how you kind of know there's a little bit of a risk on trade, because Zoom's down 1%. People are selling puts here?
Yeah.
Okay.
As far as unusual option activity, and I like this strategy. If you're not sure of a company, I mean, this stock's still down 37% from year-ago levels. It's rebounded about 5% so far in 2023. But if you looked at their last quarter, they grew. The growth in customers contributed more than $100,000 in the trailing 12 months, increased by 27% in 2022. And they're starting to build out more tools using AI, according to the company, their AI solutions into products to empower customers, be more productive. But that being said, it seems like Microsoft's kind of eating their lunch on the side of this. More people are starting to come into the office. So the need for that, does the growth stagnate in those big main enterprise customers that they rely so heavily on? I think that's one of the concerns. But some of the unusual option activity in here was somebody selling puts to the downside. So you're taking that bullish stance, but you're giving yourself a little bit of duration and a cushion to the downside. So trader came in and sold 7,000 of the June 65 strike puts for an average credit of nearly $4 on those. So the break even just above $61 a share over the next 2 months. That's about 14% below the current share price, with put volume about 3 times normal daily average volume, so that we've seen over the last 5 trading sessions. So this is that, kind of conservative way to take that bullish view where you're still giving yourself plenty of room to the downside, giving yourself duration about 67 days. But you're only getting hurt on something like this if the stock goes below that break even, which I mentioned is just about $61 a share. So in this type of environment where there still might be some risk to the downside, this trader is taking a more conservative view, but still a little bit bullish.
Okay, so it's pretty optimistic. Yeah. It's looking for this stock to basically stabilize after it's been fighting to hold on to lows now for months.
Right.
All right, let's talk the big ones today.
Yeah.
Micron, Apple.
Right.
That's what I'm most interested in here because they seemingly have 2 very overlapping macro stories about waning demand.
Yeah.
2 very different responses, though.
Yeah, and I'm pretty surprised by it. Which one do you want to hit on first? Because I've got my opinion.
Well, let's see. The NASDAQ is still red, so let's talk some Apple. It's down 2%. By the way, it's really not catching much of a bid.
No.
Despite the market trying and a lot of other stuff, tech-related and risk-on.
Yeah, still up 24% this year, but I think it was that IDC report that came out where hardware sales are down 29% from year-ago levels. Apple's PC sales down 40.5%. So that was the big outlier there. That's why you're seeing some weakness in Apple shares today. Weak demand, excess inventory, and worsening macroeconomic climate were all contributing factors for the drop in shipments of traditional PCs, according to IDC and their report. They've also got some of the headwinds, some of the stores trying to organize unions. That's also a cautionary tale. But at the same time, the stock has done really well. Demand on their iPhones, that's where they make a lot of their monies. Now, the PC sales, that'll probably hurt on this quarter basis as we pull down in those sales. But at the same time, this isn't a main driver of their earnings growth moving forward. But that being said, there were trader in there buying some puts, maybe to either hedge a long stock position or just taking that outright downward bias here because had a trader come in and buy 6,000 of the July 160 strike puts. So these are basically at-the-money puts. Paid a debit of $8.35 on average for those. So the break even for this trader where they start making money at expiration, $151.65 over the next 102 days. It's about 6% below the current share price in there. Now remember, the low that got put into Apple last year was in around the 120 level at that point. So you need a significant pullback, but not massive. You're going to capture that earnings event that comes in just a few weeks here. So, somebody's setting up for some downside here in Apple based on maybe that report and maybe the fact